Hello and welcome to today's video. In today's video, we'll basically take a look at how to identify the best trading strategy for yourself. Basically, there are different trading strategies out there, but for every individual, a different trading strategy is going to turn out to be the best strategy. And the reason is very simple. If you look at an individual and we see different professions like doctors, lawyers, engineers, everybody will not be a good engineer, everybody will not be a good lawyer, everybody cannot be a good doctor. Why is that so? Because you have some inherent inclination towards a certain kind of profession, because the tasks that need to be done there, your mind is well suited for them, and you basically are easily able to execute those tasks with almost perfection. So in this particular video, I'm going to tell you how you basically identify the best possible trading strategy for yourself, and along with that, I'm also going to call out the strategy that I use and how I basically went through this journey of identifying what's the best possible trading strategy for me. So this is basically what we'll cover. We'll look at the different trading strategies which are available and which one is the best for you. How do you identify that? That's basically what we're going to take a look at. A quick look at the disclaimer here, that whatever information I'm sharing with you in this video is only for entertainment purposes. It is not any kind of trading or investment advice. So in case you plan to invest or trade with your money, please make sure that you get in touch with a certified financial advisor and clearly understand the risks involved in trading and investing with real money. So the first criteria that I want to call out is time frame. And why time frame? Because trading strategies are built around this. Different people want to trade in different time frames. On one extreme end, we have something called day traders, basically people who take multiple trades within the same day. So day traders, they do not hold any positions after the markets close. They'll basically close out all their positions before the markets will close. So they don't usually have any overnight risk. That means if the stock that they have bought or sold, if it gaps down or gaps up, they don't basically have any risk. Why? Because they will eventually close out all their positions before the market closes for the day. So within the day, they are going to take different positions and they will close that positions before the market closes for the day. That is called day trading. So what day traders try to do is basically they try to capture small moves on the upside or the downside and take small profits. But day traders will usually try to capture a couple of cents of profits, but the volumes will be large. So they may be trading with 10,000 shares, and even if there is a 10-cent movement, you've basically made $1,000 on that particular trade. Now, day trading, if you at all want to get into it, is, I believe, the toughest of the three. And day trading is not there for everyone. In fact, there is a pretty good evidence that day trading does not work at all. So the reason for that is because number one, you have to be glued to the screen. Okay, when you're day trading, that means these are the kind of traders whom you'll see have 5 6 screens, because they're looking at multiple charts at the same time, because you don't know when that opportunity to get into a trade will all of a sudden appear. And day trading is mostly based totally on technicals, because fundamentals, if you apply any logic, will not play any role here. Fundamentally, if a company stock is strong or not strong, within a day the fundamentals of a company will not impact the stock price directly. So fundamentals don't play any role here. It is mostly based on technical analysis. And basically day traders will try to capture those small gains over a large number of volumes. And the 2 3 requirements here are: number one, you have to be glued to the screen till the time the markets are open. Second thing is, you have to spend a lot of time in preparing yourself, because you're essentially, you have to be really quick, because you may have to get in and get out of positions within like 5 minutes, or even in a lesser time frame within 2 3 minutes. So this is not suitable for most people, because it's a lot of pressure. You really need to get into positions and get out of positions, plus you cannot use fundamental analysis to your advantage. So I don't day trade, I don't do scalping. I basically get into something called, which is the next category, the swing trading. So if you've been watching my videos and if you've been looking at the community tab and where basically share my trades, you will see that most of my trades are swing trades. And swing trades essentially are trades which last for a couple of days, up to maybe 45 50 even 60 days. So that is swing trading, and that is the kind of trading that I basically do. Advantages are straightforward. First of all, you're not glued to the screen. It's not a pressure cooker situation. So if you want to take a position, you can take your time. I can easily spend 15, 20 minutes, even an hour, 2 hours when I see an opening and a trade forming up. I can take my time to analyze further, see all the relevant news. Why is the stock moving down? Why is the stock moving up? How are the fundamentals? Just reevaluate everything, take my time, and then I can take the trade. The reason is that I am not looking to close the trade within the next 5 minutes. So I don't have to be quick, really quick in taking the trade. I can take my time. I can make sure that everything looks good and only that then get into the trade. The second thing is, because I'm holding on to the trade for 30, 40, 50 days, I'm willing to do that. And in my strategy, if you follow it, in case I end up buying shares at a discounted price, I can hold them for even a longer period because I don't mind doing that. So for me, swing trading works perfectly, and that is the strategy which I use. So you basically will not have a pressure cooker situation. You can use the fundamentals of the company to your advantage, and you can also basically take your time to take the trades and then exit the trades. In day trading, it's totally very quick. You have to be very quick on your feet. You are glued to the screen. It's a lot of work during the day, so it doesn't at all go with the theme of the channel, which is serene trading. It's no longer serene trading. It's the most tedious and most I would say the most you will exert the maximum amount of effort in day trading, and the results are not phenomenally different from what swing traders or long term investors get. So I would suggest that people go with swing trading. At least that is what I do. So in case you are planning to trade, you need to evaluate all the different time frames and how things work out for you, because some people can day trade very effectively, whereas some people cannot be glued to the screen all the time because they have a day job or they have other responsibilities and they cannot basically focus on one thing for the entire day. So the third category here is long term investing. This is what people like Warren Buffett and Monish Pabrai and others do. So basically, they identify a company which is undervalued, they identify a company with a strong moat, they identify a company which has good growth potential and has a good management, and then based on that, they make an investment. So in this particular style of, it's no longer trading; it's basically a style of investing now. In this particular technique, what the expectation is that a good company with a good management is undervalued right now. So in due course of time, this company's sales, revenues, the profits, the EPS, everything is going to grow. It's going to improve, and because we have a good management to take care of things, this value will be returned to the shareholders eventually. So this is long term investing, at least 5 years. It could be 10, 20, 30 years depending on when your targets are met or when the situation becomes overvalued. So these are the time frames. First thing, when you want to decide a trading strategy for yourself, you need to decide what is the right time frame for you. Are you comfortable doing day trades? That means you want to get in and get out of positions very quickly. If it is too tedious for you, then look at swing trading. Are you comfortable holding on to positions for a significant amount of time, which is longer than day trading, but not as large as investing? Because in swing trading, what will happen is you will have your returns in 20, 30, 40 days. So you get those profits, you book those profits within that time frame, whereas investors have to wait for a long time. So with investing, you just put in your money and you forget about it for 5 years, 10 years, and you basically have to be very patient. Plus you need to have capital which you don't have to use immediately. So these are the three different trading strategies that you can form based on the time frame. Next is instruments, and this is very important. um, the first thing is that you just trade in stocks. So you buy shares or you sell shares of a company. That is long and short positions. Very simple, very straightforward. The other thing is basic option strategies. This is what basically I use most of the times, which is selling puts and selling calls. So if I don't own shares in a company, I'm basically selling puts on those particular stocks below the price. And my puts, the strike price that I use is such so that in case I have to buy the shares, then I will be buying those shares at a price which is basically below the intrinsic value of the company. So if a company's intrinsic value, let's say I calculate it at $100, first thing is I'll get into a trade if the company is trading around 80, that means below its intrinsic value, and then I'll sell probably the 60 puts. So what it does is it tells me that the intrinsic value of the company is 100, But eventually, in case I end up buying shares of this company, I'm going to be buying shares at $60 minus the premium, whatever I have collected. In case I don't end up buying shares of the company, then the premium is something that I get to keep. So the second strategy is the basic option strategies. The third strategy is again a slight extension of the basic option strategies of selling options, and that is called credit spreads and debit spreads. So again, in this case you're dealing purely with options. You will not end up buying shares of a company, and so this is not something that I use, because the trades that I take in, I basically am willing to buy shares of the company. In fact, I want to hold shares of the company if I get in on those shares at a certain price. So for me, the approach is very different, so I don't use the third option here. The fourth option is exotic option strategy. So you will hear the various terms, butterflies and iron condors and different things. These are multi-leg option strategies. So you buy a couple of options, you sell a couple of options, and you have calendar spreads and a lot of other techniques. I'm not covering them here because these are all complicated option strategies, and that's the fourth category. So again, in order to decide this, first thing is you have to know, do you understand how options work? If the answer is no, then you have no other option but to simply stick to buying and selling stocks. That's it. In that case, also, I would not suggest you to short stocks unless you know how to really put the stop losses, because even if you put a stop loss and you've shorted a stock and it gaps up, you can take a big loss. Because for shorted stocks, your downside on the upside, your downside if the stock starts going up is unlimited. So don't take that risk. I would not recommend that. So the easiest strategy for you is to be long stocks which you feel are undervalued, and then when you feel they have reached the target price or they are overvalued, you can sell them off. If you understand options, the best way, in my opinion, that I found works for me was the second option, which is basic option selling strategies. Because with spreads and exotic strategies, you need to have a much more in-depth knowledge of options. Plus, you will pay much more higher brokerage, because spreads and these exotic options have multiple legs. So for every leg, your broker is going to charge you premium unless you're using a totally brokerage free account like Robinhood or something. But if you're using most of the other brokers, they will have some charges, and the more number of legs you have to execute means more number of contracts you are buying and selling, so more premiums you have to pay. Plus, adjusting those options and basically forming a reasonably consistent strategy, it becomes difficult. So I've just given you an overview of what each of these options entails, and I use the second option here. I just sell put options on stocks that I don't own but I want to own eventually, and I sell covered calls on stocks that I own. So I basically collect this premium, and that's the strategy that I use. Third one is, how do you select the stock? Now this is where the screeners come into picture. So you've decided that you want to, let's say in my case, for example, I decided I want to be into swing trading. That means my time frame is going to be somewhere between 2 3 days to 30 45 50 days. That's my time duration for which I want to hold a trade. Second thing that I decided, what instruments do I want to use? I want to use the basic option strategy, selling option premium. That means selling calls and selling puts. That's it. So two things are decided in my trading strategy. The third thing, which is the most important thing in fact, is how do I identify the stocks that I want to trade? So we basically have two different kinds of major groups. One is called the fundamental or the value investors. So these people will look at the fundamentals of a company, like what's the intrinsic value. That means usually the model that is used is the discounted cash flow model. So you take the future earnings of a company and then you discount them and see that what is the company worth today and what is it trading at. So if the company is trading at a price which is lower than its intrinsic value, the company is said to be undervalued and is a good investment opportunity. They look at companies with strong balance sheets, means you don't want to have companies with too much of debt, because if something goes wrong for a year or two, it should not happen. The company cannot pay off its debt and it has to file for bankruptcy. You look for companies with good moats. That means the competition cannot just come in and take away the market from them. Companies which have good managements, means managements which take decisions in favor of the shareholders, like buying back shares when the share price is low, or taking other decisions, like you have a portion of the business which is not doing well. Are they willing to liquidate the business and be done with it instead of logging in losses year after year? So the quality of the management is very important. And in general, how is the sector, how is the market doing, what are the macroeconomic conditions? So you basically look at the fundamental picture and you decide whether to buy in or a company or not. So these people will be called value investors. The second thing is technicians. Technicians will not look at the statistics of a company, the financial statements of a company. All they're interested in is in the price action, because technicians believe that if a company has good fundamentals, it has good management, this will be reflected in the price of the company. So they really need not bother and look at the financial statements. So the only two parameters the technicians will look at is price and volume, because this is the only two pieces of information that you get out of a stock exchange. If you look at any day's data coming out of a stock exchange, it only tells you the price movement second by second, and it tells you the volume for every second. So if you look at a 5-minute chart, you're basically seeing every 5 minutes where did the price go and what was the corresponding trading volume within that 5-minute time frame. So this is the information that technicians want to see, and their logic is that there are certain things like supports and resistances and technical indicators, and these chart patterns basically they repeat themselves. So if a stock has come down to $100, and every time it comes down to $100 the buyers step up and they push the price higher, chances are that next time when the stock comes down to $100, the buyers will again step up and they will push up the price higher. So the $100 level is considered as kind of a support. So technicians rely only on the chart patterns. And then you have techno fundamental traders who basically use both the concepts. So I belong here in the third category. So if I want to now clearly put out my strategy in a couple of lines, the first thing is that I am into swing trading, which basically means I hold on to my trades for a couple of days, ranging from maybe 2 days to 40, 50 days. I execute my trades using options by selling put options or selling call options. If I don't own the stock, I sell put options. If I own the stock, I sell call options. And in order to decide on which stocks should I execute these kind of trades, I basically look at their fundamentals, identify undervalued companies, and then I look at the charts to identify the exact entry or exit prices. So let's say I identify a stock which is undervalued. Now, obviously, I want to also use technical charts to see which is the next support level, because chances are if I get into the position at the support level, that it's going to be profitable. Why? Because at the support level, if I'm selling a put, chances are the price is going to bounce off that support level and go higher. So I can collect the maximum amount of premium and I can basically gain the maximum amount of money in that trade. So hopefully you understand the different trading strategies, and I'll just go back quickly and I'll tell you. So if you look at the time frame criteria, we have three possible options. If you look at the instruments, you have four possible options. So 3 multiplied by 4 is 12. So if I use these two criteria, time frame and instruments, total 12 different options can be created. That means you can have 12 different versions that you can create. If I take the third thing, how do you select your stock? You have three different options. So 12 into 3 is 36. So totally, if you look at the three parameters, you can actually create 36 different combinations, which is a huge number of combinations. So if you're starting, if you're a beginner, the first thing is write down in an Excel file these 36 combinations and see which one works the best for you. Because I can tell you, I can assure you that most of these options you will be easily able to reject on the face of it. People can immediately tell that they don't want to be into day trading. If they're towards a longer time frame, they will probably have a confusion between swing trading and long term investing, but they will never have a doubt on day trading. Same way, people who do not want to invest in the long term, they will be very clear. They either want to be day traders or they either want to be swing traders. They'll clearly know, I don't want to be a long term investor. Same way, the instrument decision is very simple. If you don't know anything about options, then you just have one option: go long stocks or short stocks. That's the only option available. If you have very limited knowledge, you don't have super confidence on option trading, you go with the second option or the first option. So this way, what I would suggest is that you evaluate all the possible combinations in this particular manner. 36 combinations will be there in all, and see what works best for you. And then you can start paper trading initially, or trade with very small amounts to see that what you feel is going to work for you actually works for you as well. Because there is no point that if your temperament is not to be a day trader and you try to day trade, you're glued to the screen and you stress yourself out, that is not the right way to trade or make money. It is not going to work for you in the long run. Same way, if you get into an investment and every day, every 2 3 days, you feel like closing a position and re-entering a position, that means you are not suited for long-term investing. You cannot invest your money and then forget about it. If it troubles you to see that my stock is not going anywhere for the last 6 months, so I should take some action, then you are not a long-term investor. You basically need to get into something which is in a shorter time frame. That is, you need to look towards swing trading. So I hope this particular information is clear, and this is something that you should be doing right at the start, because once you are clear with your trading strategy, then you can develop more skills and you can develop a better understanding. Plus, it's the same thing that a person who has the basic skill set and mindset to be a doctor, if you put him in any other profession, like an engineer or a programming profession, which where a person does not understand coding at all and has no inclination towards that area, that person is going to struggle. But a person who has a basic inclination or a technical mind, if you put that person into programming or anything, that person eventually is going to do very well. So I hope the message is clear, and this will help you in deciding your perfect trading strategy. One thing that I want to call out, I am putting the trades that I take on the community tab of my channel. So go to my channel, Serene Trading Strategy, and there you can go to the community tab. And the trades that I take, I'm actually putting those trades there. I place the details of the trade when I take the trade, when I close the trade, I put those details also there. And we keep a track of the running profit and loss for the trades that I'm taking. And most services will actually charge you money to share their trades with you. I'm not charging any money. This is free of cost, because I just want people to be able to follow my trades, to see what I am doing and see if it helps in their education, if it helps in correlating the concepts that I'm explaining in the videos better. So this is free of cost right now. So you can just go to my community tab and see the trades. I put in a lot of effort that as soon as I take the trade, I try to put the trade on the community tab within a few minutes, or maximum half an hour, 45 minutes. But the easiest way that you don't miss that information is that you subscribe to the channel if you've not already done so. Because if you subscribe to the channel, the moment I put the trade, the moment I post the trade on the community tab, you will get a notification. So as soon as I take a trade, you get notified. You can immediately go and see. And normally those trades, because I swing trade, are valid for 30-40 days. So chances are that those trades will be still valid. But if you want to follow the trade right from the beginning, at the time when I have taken, all you need to do is subscribe to the channel so that you get notified as soon as I take the trade. And that way you will not miss any of the trades that I'm taking. You can follow all those trades, and that should probably help with your learning. So that's it from me for this video. Thank you for your time. If you like this video, please like the video and subscribe to the channel if you've not already done so. Share this with your family and friends. I hope this content is useful. And if you have any comments or suggestions, please leave them down in the comment section. I'll definitely respond to you, and I'll catch you guys in the next video. Thank you so much for your time.